When you're new to options trading, typically you begin by learning the 4 basic option strategies, which are buying a call, selling a call, buying a put, selling a put. Those are the 4 basic option trades. We call those single leg strategies because they only involve one option. But very quickly after you learn the 4 basic option strategies, you typically, as an options trader, you discover the wonderful world of vertical spreads. What's a vertical spread? Well, that's when you buy a call and sell a call at different strikes, but in the same expiration, or you buy a put and sell a put at different strikes in the same expiration. So, option strategies explained. Today we're talking about vertical spreads. So, what is a vertical spread? Well, a vertical spread involves the simultaneous buying and selling of 2 options of the same type, so both calls or both puts. So, it's the simultaneous buying and selling of 2 options of the same type, but at different strike prices and in the same expiration. These spreads can be either long spreads, meaning you are required to pay a debit, or short spreads, meaning that you receive a credit. And this is very similar to your 4 basic option strategies as far as your naked option strategies. So when you buy a call or you buy a put, right, we call those long calls or long puts, you have to purchase those, right? You have to purchase those, which means you pay a debit to purchase those long options. The same thing with a long spread. We call it a long spread because you have to purchase it, meaning you are required to pay a debit to purchase that spread. Same thing on the other end, short spreads, meaning that you're on the other end of that particular trade, meaning that you receive a credit to sell that spread. Now, referring to these spreads as either long spreads or short spreads can be a little confusing, because most traders, especially if you're coming from the stock trading world, anytime somebody mentions something being long, they're usually thinking long as in directional assumption. It's a bullish trade, or short. They assume when you talk about something being short, it's about directional assumption. It's about being bearish, but that's not what we mean in the options world. When we talk about option strategy being long or short, we're talking about you either had to pay for it or you had to receive a credit for it. Luckily, most options traders these days seem to refer to these spreads as either debit spreads or credit spreads. So we don't typically call them long spreads or short spreads. We just, if it's a long spread, we're going to call it a debit spread instead, right? Because that just makes more sense. It's obvious to everybody. I had to pay to purchase that spread, right? And if I say something is a credit spread, it's obvious it's a short spread, right? It's obvious I sold the spread and I received a credit for selling it. And for me, I'm almost always going to refer to these things as either put credit spreads, call credit spreads, put debit spreads, or call debit spreads, because I think that is a much clearer explanation of what these 4 different spreads are. But there are a lot of terminologies you'll use. Some people will call these things bull put spreads, bear call spreads, bear put spreads, and bull call spreads, as I've demonstrated here in the table. Some people will also just refer to them as a long put spread, a long call spread, a short put spread, a short call spread, right? You've got different terminology for, again, the exact same things, but most people, I would say about 90% of the time when people are talking about vertical spreads online, they use these 4 names here: the put credit spread, the call credit spread, the put debit spread, and the call debit spread. But you need to be aware of all the other possible names you might hear for vertical spreads, because sometimes people do use the alternative names. So the next chart is this little diagram. In my previous videos about the 4 basic options trades, right, I had this diagram trying to clear up some of the confusion, especially if you're new to options, about what a long call versus a short call versus a long put versus a short put. What are they as far as a directional assumption? Well, here I did it with call debit spreads versus call credit spreads, and put debit spreads versus put credit spreads, right? And you can see that a call debit spread is essentially your long call spread, or your bull call spread, if you want to call it that, right? It's a bullish trade, right? And because it's a debit trade, meaning it's a trade that I had to purchase, just like when you buy a call or you buy a put, typically you don't want to do that in a high IV environment. You much prefer IV to be really low if you have to buy an option. The reason for that is because you're buying the option. You want the premium to be as low as possible when you're purchasing something. So anytime you're doing anything for a debit, you want low IV. So the call debit spread is a bullish trade, and you want it to be in a low IV environment. Now, on the other end, if you're selling that spread, so you're doing the call credit spread, then obviously the directional assumption is the other direction. It's a bearish trade, and you prefer high IV because you're selling the spread, meaning you're receiving a premium, so you want that premium to be as rich as possible. So you actually want high IV. And for the puts, put debit spread is a bearish trade, and again, it's a debit spread, meaning you paid for it, you want low IV so that the purchase price is as low as possible. A put credit spread, of course, is a bullish trade, and we want high IV anytime we sell options. So let's go over the 4 vertical spreads. Let's start with the put credit spread because I think this is going to be the most common vertical spread most traders use. Much like of the naked options, I tend to prefer just selling puts as a strategy. When I do spreads, I much prefer selling put spreads. So I'm doing the put credit spread most of the time. So what is a put credit spread? Well, it consists of one short put with a higher strike price and one long put with a lower strike price. The max reward is the credit received, just like it is with just your single leg short option. So if you sell a put or sell a call, what's your max reward? Well, it's the credit you received when you sold that option. Same thing with vertical spreads. When you sell the spread, what's your maximum possible reward? It's that credit you received when you put on the trade. Now, the max loss is interesting because unlike a short naked put, the put credit spread, because we have this long put, we've capped our downside risk. A naked short put has unlimited risk to the downside because the stock can just fall forever. Well, it can't fall forever. It can fall to zero potentially, but that's essentially unlimited risk. That's undefined risk. Well, this long put defines our risk. We cap our loss right there. So I can't lose more than the strike price of that long put. So we've capped our downside risk. Now, that's not just something you can do for free, right? We had to purchase that put. So yes, we've capped our downside risk, but because I had to pay for the long put, that means that my max reward is also reduced because purchasing that long put cost a little money. So yes, I capped my downside risk by doing the put credit spread, but I've also reduced my profit potential also. So, the put credit spread, what it does, it's basically all these spreads, the put credit spread, call credit spread, put debit spread, call debit spread. All these are in some ways smaller versions of the naked options, right? You're not going to have typically as much risk on these plays. You're also not going to have as much reward on these plays. And for new options traders, this is really the reason why vertical spreads are appealing, is because, you don't have those wild P&L swings that you do with naked options, right? Yeah, it smooths things out a little bit. Getting back to the max loss on this put credit spread, the credit spreads, their max loss is always going to be the width of the spread minus the credit you received. So if this spread is a $5 spread, meaning I sold the 100 put and I bought the 95 put, right? So there's $5 between the spread, right? That's a $5 spread, $500 essentially, because options represent 100 shares of the underlying stock. Let's say that overall I received a credit of $1 for selling this put credit spread. That's a $5 spread. So what's my max loss? Well, my max loss is the $5 width of the spread minus the $1 credit I received for selling the spread. So my max loss on that trade would be $4. If this was a $4 wide spread, so say I sold the 100 put and I bought the 96 strike put, and let's say I received a credit of $1.50, well, what's my max loss on that spread? Well, you do $4 minus $1.50, my max loss on that spread would be $2.50. That's how that's calculated. Of course, your trading platform will give you all this information anyway, but just mentally, it's very easy to figure out what your maximum profit and your max loss on these trades are. So mentally, you almost really don't even need the trading platform to figure out this stuff. And once again, our directional assumption on a put credit spread, it's a bullish trade, and volatility, because it's a credit spread, we want high IV. Moving on to the call credit spread. The call credit spread is just like the put credit spread, except it's done with calls, and it's essentially a bearish trade instead of a bullish trade. So on a call credit spread, we have one short call with a lower strike price, one long call with a higher strike price. Again, the max reward is the credit received for selling the spread. The max loss, once again, is the width of the spread minus your credit received. So if this was a $3 wide spread, so let's imagine that I sell the 50 call and then I buy a 53 call. So that's a $3 wide spread. Now let's imagine I receive a credit of $1.20 for selling that spread. Well, what's my max loss? Well, my max loss is the $3 width of the spread minus 120. My max loss is 180. Again, these things are very easy to figure out. That's one of the things about vertical spreads. It's always easy to know exactly what your max reward and your max loss is on a trade just very quickly as soon as you put it on. Another thing to be aware of with credit spreads, whether it be a put credit spread or a call credit spread, unlike naked short puts or naked short calls, your buying power requirement it is much less because your buying power requirement on a defined risk trade is always the max loss. So the only thing you have to put up is your maximum possible loss, and your buying power requirement will never change over the life of the trade because it's a defined risk trade. The max loss can never change. Where on naked short puts, naked short calls, your buying power can change drastically if that naked short option starts going against you in a big way. Now let's talk about the debit spread. So let's start with the put debit spread. So a put debit spread consists of one long put with a higher strike price and one short put with a lower strike price. So essentially we've just moved the short put and the long put, right? We flipped the position, right? So now the long put is really the driving force behind this trade rather than the short put. So the short put was the driving force behind the put credit spread. That's why you received a credit for selling that spread. But now the long put is really the driving force behind this, and we have to pay a debit for the put debit spread. Now let's talk about max reward and max loss. Now remember, with the credit spreads, our max reward was always the credit received, right? And our max loss was always the width of the spread minus the credit received. Well, things are a little different with debit spreads because we pay a debit. So actually our max reward involves the width of the spread minus the debit paid, and our max loss is actually defined as just the debit paid to purchase the spread. So calculating max reward on a put debit spread, let's imagine that the width of the spread is $10. So imagine I sell a 100 strike put and I buy a 110 strike put. Well, that's $10 between them, right? That's $1,000. That's a $10 wide spread. And now let's imagine that I paid a debit of $325 to purchase that put debit spread. What's my max reward? Well, $10 minus $325 is $675. So my max reward is $675 on that trade. Now what's my max loss? Well, my max loss is $325. And that's what I paid for purchasing that spread. That's the most I can lose. On a debit trade, always the most you can lose is what you paid to purchase that option, or in this case, these two options. The put debit spread directionally is a bearish trade, and because you're buying a spread, right? You're having to pay a debit for it. Volatility, you want low IVR. You want really low IVR. And moving on to the call debit spread, it's essentially like the put debit spread, except we're doing this with calls instead of puts. So a call debit spread consists of one long call with a lower strike price and one short call with a higher strike price. Once again, your max reward is the width of the spread minus the debit paid. So if we imagine that I have a $5 wide spread here, so let's imagine that I buy a 50 call and I sell a 55 call. That means the width of that spread is $5. Let's imagine I paid a debit of 75 cents to purchase that spread. Well, what's my max reward? My max reward is $5 minus 75 cents, $425. That's my max reward, $425. What's my max loss? Well, my max loss is the 75 cents I paid for the spread, the $75, right? So again, these things are very easy to figure out mentally, but again, if you're not great with math, of course your trading platform is going to give you all of this up front when you put on the trade. The call debit spread is bullish and directional assumption, and once again, because it's a debit trade, you have to purchase this spread. You want low IVR, right? Because you want those option premiums to be as low as possible because you don't want to have to pay as much for the spread, right? You want to buy the spread as cheaply as possible. So IV plays a crucial role with really most option strategies, but especially vertical spreads, right? We've already talked about you want high IV for credit spreads. You want low IV for debit spreads. When IV is high, option premiums, of course, will be high, making short option strategies like credit spreads attractive. When IV is very low, debit spreads are attractive because they will not cost you as much to purchase those spreads. If the IVR of an underlying asset is 30 or above, and this is, kind of arbitrary, just a number, right? But anytime IVR is at least 30 or more, I typically default to short option strategies. So in this case, if I was planning on doing a spread, a vertical spread, then I'm almost always going to choose doing a credit spread spread over a debit spread if the IVR of the underlying asset is 30 or more. Now, if the IVR is below 30, I might choose a debit spread instead, but maybe I'll choose a credit spread. Still, it's a little iffy, which one I'll do. But if IVR is very low, so if we start getting IVR, say 15 or even 10 or below, that's a very low IVR. Then I'm almost certainly going to choose a debit spread in that situation. And because of what we mentioned with credit spreads need high IV, debit spreads need low IV, credit spreads naturally have negative vega and benefit from IV dropping, and debit spreads have positive vega and they benefit from IV rising. So let me switch over to my trading platform, and this of course is TASTYTRADE, and let's just see some example trades here. So I'm going to put on a few different trades. I already got a position on in Amazon at the 33 DTE mark. So I'm going to go out to 68 DTE, and Amazon right now IV rank is 63. That's a high IV rank. So if I was going to do something, I would do a credit spread. Am I going to do a put credit spread or a call credit spread? Well, let's take a look at the chart. It's very bullish. So I don't even need to look any further. I'd probably want to do a put credit spread, a bullish strategy. So what I'll do is I'm probably going to do something like sell the 30 delta. So in this case, the 175 strike is 31 deltas. I'll sell that and I'll go $5 wide and I'll purchase a 170 strike put. You can see for selling this put credit spread, I'm going to receive 137 credit. So what's my max loss on the trade? Well, it's a $5 wide spread and I receive 137. What's my max loss? My max loss in this case would be 363 because that's $5 minus 137, right? But again, the trading platform's going to give me all that information. If you wanted to see the risk profile on this, let me get some of my current positions off of here. And this is the put credit spread. So this is what it looks like. It's exactly what I showed in the slideshow, right? By purchasing that lower strike put, right? We've capped our unlimited downside risk that we would have with just the short put, right? We've capped that at the 170 strike put. Now let's imagine that for whatever reason I want to be a contrarian, and instead of the put credit spread I want to do a call credit spread. Well, I'd just do that exactly the same. Probably I'd go to like a 30 delta option. So here the 202.50 is a 30 delta option. So I'm going to sell that call. I'm going to go $5 wide to 207.50 and I'm going to purchase that call. And overall, this call credit spread, I'm going to receive 122. Now it's a $5 wide spread, $5 minus 122. What's my max loss on the trade? Well, it would be 378. And again, your trading platform is going to tell you all of this information anyway. And of course, this is a bearish trade. So if I go take a look at the risk profile for this one, you can see now, we want the underlying stock to go down. And with credit spreads, typically you're going to do these out of the money, exactly like I just did. Just like if you're doing naked short options, right? I've mentioned this, for a naked short option, I didn't mean to click that. Anytime you do a short put or a short call, you want to sell them out of the money, right? Because that means you have a greater than 50% chance of winning on that short put or on this out of the money short call, right? You're always going to sell them out of the money. And same thing with short vertical spreads, which are credit spreads, right? And they're short because you receive a credit. Same thing. You want to do them out of the money, right? So you're always going to sell your credit spreads out of the money. You're never going to sell them in the money. You can, but again, I like to win on my trades more than 50% of the time. I don't like to lose on most of my trades. So typically on credit spreads, sell them out of the money. Now, debit spreads are a little bit different. They're a whole different kind of animal. So let's talk about moneyness and spreads. So much like short options are almost always sold out of the money, short vertical spreads, credit spreads are also typically placed as out of the money trades. Now, because the short option is the main driving force behind a credit spread, this means that credit spreads are positive theta, meaning they benefit from the passage of time. So just like short puts and short calls benefit from theta, from the passage of time, short put spreads and short call spreads, credit spreads, right? So a put credit spread, a call credit spread, they benefit from the passage of time because that short option has more power in a credit spread than the long option does. Now, debit spreads are different because debit spreads have to be purchased, and because they have to be purchased, if you want to purchase them in the money, you can. If you want to purchase them out of the money, you can. But a common play with a lot of options traders is actually purchasing an at the money debit spread where you have the long option in the money and your short option out of the money. This kind of at the money debit spread gives you essentially a 50-50 type trade, right? It's basically a 50-50 shot on the trade. You pick a direction and you go with it, right? It's similar to like buying stock, really. But the difference is it's a defined risk trade and it has slightly positive theta, which is really nice, especially considering it's a low IV trade and you're actually paying a debit. There's not very many debit trades you can do with options where you're actually positive theta, but these debit spreads can achieve just that. So let's do a put debit spread. Let me pick a different ticker symbol. Let's go to Shopify. I don't have a Shopify position at the moment. Let's go to 33 DTE. Now, the way a debit spread, one of these at the money debit spreads, which is, again, probably the most common way a lot of traders trade these things. What we would do, let's do a put debit spread. Let's imagine I'm bearish on Shopify. So a put debit spread, I need to sell a put. So I'm going to sell this put that is just slightly out of the money, right? It's on the other side of the at the money strike. And then I'm going to buy a higher strike put on the other side of at the money. And actually, Shopify printed exactly 7. So really to straddle this thing exactly perfectly even, I'll do the 65 short put and the 75 long put. And that's about as perfect, in between as you could get, right? Now, these kinds of at the money debit spreads, whether it be a put debit spread or a call debit spread, when you're straddling right here at the money, basically, what you're doing is it's going to be a 50-50 type trade. And typically your max profit and your max loss are going to be about the same. And you can see that's the case here. So right now, my probability of profit on this trade is saying it's 57%. So I have a slightly greater than 50-50 chance of winning on the trade. And typically these things will have very slightly positive theta, or at the very least, no real theta at all. And you can see my theta number here is actually pretty much 0. So theta's not going to hurt me. It's not really going to help me either. But that's kind of good anyway, because, again, on debit trades, typically theta is a negative force. It's working against you. At least on this type of trade, theta should not punish me in any way on this trade. Max profit and max loss, again, are typically very close to being the same number. You see max profit 483, max loss 517. Of course, the two together make up the $1,000. It's a $10 wide spread, right? So if we wanted to see this in action with calls, it would be essentially the same thing, except with calls, I'd buy the 65 call and I'd sell the 75 call. The probability of profit is 43%. Remember, it was 57% on the put side. So it makes sense that it's only 43% on the call side. My theta number is very slightly positive, 9 cents of theta, but hey, I'll take it. Max profit 520, max loss 480. Again, those numbers typically very similar because it's, again, at the money trade. It's essentially a 50-50 shot. And basically you're risking, whatever amount of money to make the same amount of money. And so basically you're risking one to make one on these types of trades. So that is typically the kinds of strikes you pick with debit spreads. So remember, credit spreads, you're almost always going to sell them as out of the money. And with debit spreads, you're typically going to do these things at the money where you purchase one in the money option and you sell one out of the money option. So that covers the basics of the 4 basic vertical spread strategies. So we covered put credit spreads, call credit spreads, put debit spreads, call debit spreads. Essentially, it's like your 4 naked options, right? Except because you're also adding that second leg to the trade. Essentially, what you're doing is you're lowering your risk, but you're also lowering your maximum possible reward on the trade. Typically with spreads, the reason you'd prefer a spread over a naked option is if you're trading an underlying that has a really high share price. For example, Nvidia right now is trading at like $900 a share. Right? A naked option, a naked short put or a naked short call would be a very expensive trade. It's going to probably cost you at least $20,000 as far as buying power reduction just to sell that option. Where a put credit spread or a call credit spread costs whatever the width of the spread is minus the credit received. Right? We've already talked about a $5 wide spread and maybe you receive $1 credit. Well, that credit spread is only going to cost you $4, right? $4 opposed to a $20,000 buying power reduction. That's nice. That's why people like these vertical spreads. And when you find a product you just can't get naked with, that's when you put on the spread. So I hope you enjoyed this presentation. If you want more explanations of various option strategies, let me know what strategies you'd like me to cover in future videos. Also, be sure to check out my book, The Super Wheel Option Strategy, available on Amazon. Link in the description below. Peace, guys.